the shadow dollar empire, ready to uncover the invisible chains dragging our future into the abyss? Hit that like, share, and ring in your subscribe or follow, because truth needs an army of awakened minds. Let's look into one of the most shadowy corners of global finance, the Eurodollar system. If you've ever wondered why the world economy feels like it's running on invisible rails, or why financial crises seem to erupt out of nowhere, this is the story for you. Today, I'm unpacking its history, how it actually works, and the massive risks it's packing that could shake things up big time. Grab a coffee, settle in, because we're going on a ride through the underbelly of money that powers everything from oil trades to corporate loans, all without a single government really calling the shots. Let's start with a little hook to get you intrigued. Imagine a massive, unregulated ocean of dollars, trillions upon trillions, flowing around the world, created by banks that aren't even in the US, funding deals that keep the global machine humming. It's not some conspiracy. It's real, born from Cold War tensions, and it's grown into something so huge that it could tip the entire economy into chaos if it hiccups. We'll explore how this hidden network came to be, the clever tricks it uses to multiply money, and why it's like a ticking time bomb in today's volatile world. Stick around, because by the end, you'll see why understanding this could change how you think about your own finances. Now, diving right into the heart of it. The Eurodollar didn't start as some grand scheme. It emerged from pure necessity back in the 1950s, amid the chill of the Cold War. Picture this: the Soviet Union was raking in US dollars from selling oil and commodities to the West. But they were paranoid, and rightly so, about parking that cash in American banks. What if the US government froze those assets like they could under the Trading with the Enemy Act? So, the Soviets turned to British banks in London. In 1957, they deposited dollars into places like the Moscow Narodny Bank, a Soviet-owned outfit in the UK. Boom! That's the birth of the first Eurodollar. A US dollar held outside the United States, free from Fed oversight. This wasn't just a one-off. Caught on fast. By the early 1960s, European banks saw the gold mine. US regulations like Regulation Q capped interest rates on domestic deposits, making it hard for American banks to compete for funds. But in London, no such limits. Banks could offer higher rates on these offshore dollars, attracting corporations, governments, and even other banks. The market exploded from a few billion in the mid-1960s to hundreds of billions by the 1970s. It became the go-to for financing international trade, especially after the oil shocks of the 70s, when petrodollars from OPEC nations flooded in and got recycled through this system. Fast forward through the decades, and it morphed into a beast. Deregulation in the 80s and 90s supercharged it, with offshore havens like the Cayman Islands, Singapore, and Luxembourg becoming hubs. Today, it's not just about deposits. It's a full-blown shadow banking network. Estimates vary, but core Eurodollar liabilities hover around $13 to $15 trillion, though when you fold in broader shadow activities like repos and derivatives, it balloons way higher. Some say over 50 trillion in interconnected claims. That's more than twice the US GDP, financing everything from Chinese factories to Brazilian farms to European energy deals. So, how does this thing actually function? At its core, the Eurodollar is about creating dollar-denominated credit without the Fed's permission. When a non-US bank takes a dollar deposit, say, from a multinational corp, it doesn't have to hold reserves like an American bank would. Instead, it lends those dollars out, often to another entity that then deposits them elsewhere, creating a chain. This is fractional reserve banking on steroids, but offshore and unregulated. The key mechanism is the mismatch. These banks create liabilities, loans, and deposits in dollars, but they can't print actual base money. That's the Fed's job. So, the system runs on trust and short-term funding tools like repurchase agreements or repos, where assets like treasury bonds are pledged as collateral for overnight loans. Rehypothecation is another wild part. In the US, there's limits on reusing collateral, but offshore, a single bond can be pledged multiple times by a hedge fund to a broker, then to a bank, then to a fund. This creates a velocity of collateral around 2.5 to 3, meaning $1 of real assets backs multiple dollars of debt. It's efficient when things are calm, multiplying liquidity like magic. But it's fragile. Add in tools like FX swaps, where banks exchange currencies temporarily to access dollars, and you've got a web that's hyper-connected. Eurodollar futures markets even predict interest rates better than the Fed sometimes, because they reflect this global appetite for dollars. But here's where it gets dicey, the dangers. This system thrives on a paradox. While the Fed might print money at home, the world often faces a dollar shortage offshore. Why? Because credit expands faster than actual dollars can be supplied. When growth slows or volatility hits, like in 2008 or 2020, lenders panic, stop rolling over loans, and demand repayment in real dollars. Borrowers scramble, selling assets, dumping local currencies, and spiking the dollar's value. That crushes emerging markets, triggers recessions, and can freeze global trade. In 2008, the Lehman collapse exposed how intertwined it was. Eurodollar funding dried up, forcing the Fed to open swap lines to foreign central banks just to inject dollars. Today, in 2026, risks are amping up. The basis trade is a prime example. Hedge funds exploit tiny price gaps between cash treasuries and futures, leveraging up 50 to 1 via repos. Positions are estimated at over 1.5 trillion, 3 times bigger than in 2020. If bond volatility spikes, say from inflation fears or geopolitics, it could unwind in a fire sale, crashing prices and sucking liquidity dry. Private credit, now around 1.7 trillion, is another hotspot. Shadow lenders like private equity firms dish out loans to risky companies, often with lax terms, hiding defaults through tricks like payment-in-kind debt. In a downturn, these could lock up, gating withdrawals and trapping investor cash. Geopolitically, it's a powder keg. China plays huge here, borrowing offshore dollars for Belt and Road without US strings. But they're short dollars, trillions in debt. A spike could bankrupt developers, as seen with Evergrande. And Fed swap lines? They go to allies like Europe and Japan, not rivals like China or Russia, weaponizing liquidity and pushing BRICS toward de-dollarization with gold and alternatives. Basel III rules, meant to make banks safer, ironically shoved more activity into these shadows, where non-banks operate without safety nets. Then there's the collateral crunch. With rehypothecation, a trust breakdown drops velocity to 1, vaporizing credit in a deflationary spiral. The Fed can print reserves, but not trust or collateral. We've seen partial freezes before, but a full one, the Great Freeze, could dwarf 2008, forcing the Fed to buy everything from junk bonds to foreign debt, inflating away value or paving the way for central bank digital currencies as a fix. Let's pull out some standout lines that capture this essence. From historical accounts, the Eurodollar market was born when the Soviets deposited dollars in London to evade US freezes, breaking the currency's tie to its creator. On mechanisms, offshore banks create dollar credit out of thin air, but rely on the Fed for settlement, creating an eternal mismatch. And on dangers, this 50 trillion Leviathan is a game of musical chairs with too few chairs. When the music stops, the global economy crashes. Or this gem. Rehypothecation turns one bond into a hologram owned by everyone and no one. Finally, the shadow market runs on trust. When it evaporates, velocity collapses, and no bailout can fill the void. Wrapping this up, if you're navigating today's world, get savvy about this. Diversify beyond traditional banks. Think direct ownership of assets, physical gold, or even Bitcoin for true outside money. Stay informed on repo rates and futures curves. They're the canaries in this coal mine. The Eurodollar's given us growth, but its risks are real. Understanding it might just help you weather the next storm. Stay informed. Stay free.